For most of the 20th century, the word retirement was sold as the ultimate promise of freedom, a golden reward after decades of hard work, a quiet house, steady income, and the comfort of never worrying about money again. But what if that dream was never meant to be real? What if retirement wasn't a gift from progress, but a financial illusion, engineered to keep people working, consuming, and saving in systems they didn't control? The truth is, retirement as we know it is a modern invention. Before the 20th century, people didn't retire. They worked until they couldn't, and their families or communities took care of them. It was only when industrial economies needed a predictable workforce and when financial institutions needed new pools of savings that retirement became a product. Suddenly, your life's final decades became a financial equation managed by pensions, mutual funds, and the stock market. It was a perfect setup. Governments gained stability, corporations gained loyalty, banks gained deposits, and the people? They gained a story, one that promised dignity while quietly transferring power to those who controlled the flow of money. Over time, retirement turned from a human need into a trillion-dollar industry built on debt, speculation, and the illusion of financial independence. But that illusion is starting to break. Around the world, pension systems are collapsing. The average person can't afford to stop working. Inflation silently eats away savings, and as populations age, the math no longer works. The promise that you could one day stop contributing to the system and live off what you saved was never sustainable. It was a dream designed to keep the system alive, not you. The question now isn't when you'll retire, it's if retirement ever really existed at all. The idea of retirement didn't come from human compassion or social progress. It began as a policy experiment designed not to liberate people, but to control them. The first real retirement system in history appeared in 1889 when Germany's Chancellor Otto von Bismarck introduced a pension plan for workers over the age of 70. It was revolutionary at the time, a state promise that you could stop working and still receive income. But the genius of Bismarck's plan wasn't moral, it was mathematical. Most Germans in the 1880s never lived to 70. The life expectancy was closer to 50. The plan wasn't a burden to the state, it was propaganda. It gave workers hope, loyalty, and obedience. The government could present itself as a guardian of the people while spending very little on those who actually lived long enough to benefit. Retirement, in its earliest form, was not about freedom. It was about social engineering, a way to keep the working class loyal to the system that depended on them. The United States would later follow this blueprint. In 1935, during the Great Depression, President Franklin D. Roosevelt launched the Social Security Act, a promise to support the elderly and protect workers from poverty in old age. It was framed as a social victory. In reality, it was also an economic tool. America needed to restore confidence, restart consumption, and stabilize the labor market. The idea that older workers could retire made room for younger ones. It kept the system efficient, the economy moving, and the cycle of work and spending intact. Corporations soon saw opportunity. Pension plans became the ultimate employee retention tool. The longer you worked, the more you were rewarded. It wasn't just a paycheck anymore. It was a lifetime contract. And when post-war prosperity hit, the illusion deepened. The 1950s and 1960s created a golden image of retirement: golf courses, suburban homes, and endless leisure. It became not just a stage of life, but a status symbol, a proof of success in the industrial age. But behind the dream was a quiet dependency. Every worker's future now depended on forces beyond their control. the stability of governments, corporations, and the financial markets that invested their pensions. Retirement wasn't built on personal freedom. It was built on trust. And that trust would soon be tested. The myth had taken hold. Retirement was no longer questioned, it was expected. But the more people believed in it, the more power it gave to those who managed it. The story of security had become the most successful financial narrative of the modern age, and the most dangerous. By the 1970s, the quiet promise of lifetime security began to crack. Inflation surged, interest rates spiked, and the post-war economic order collapsed. Governments could no longer sustain massive pension obligations, and corporations started looking for ways to offload risk. What began as a moral duty to care for workers in their final years turned into a financial liability. And in that moment of crisis, a new system was born, one that would transform retirement from a guarantee into a gamble. In 1974, the United States passed the Employee Retirement Income Security Act, better known as ERISA. It sounded protective, a safeguard for pensions, but it opened the door to a new kind of financial experiment, the Individual Retirement Account, or IRA. A few years later, the 401k followed. For the first time, ordinary workers became investors. They were told this was empowerment, control over their financial destiny. But what it really did was shift the burden of risk from corporations to individuals, while channeling trillions of dollars into Wall Street. The financialization of the future had begun. Retirement money was no longer sitting safely in pension funds. It was being speculated in stocks and bonds and derivatives. The market became the lifeblood of every retiree's hope. If it went up, people felt secure. If it went down, their entire future collapsed. The system that promised stability was now tied to volatility, and the financial industry thrived on it. By the 1980s and 1990s, a new class of financial products emerged: mutual funds, index funds, annuities, target date portfolios. Each one promised a smarter, safer path to retirement, but all were built on the same illusion, that perpetual growth was possible, that the market somehow could always rise faster than the cost of living. The dream of retirement had been transformed into an engine of speculation. Meanwhile, the human side of the story was changing. People no longer worked for a single company for life. Job security vanished. Pensions disappeared. And yet the dream remained the same: retire by 65, live comfortably, trust the system. But now that system depended entirely on global finance. Every paycheck contribution fueled Wall Street's growth, while ordinary savers unknowingly became the liquidity providers of a machine they didn't understand. By turning retirement into an investment problem, the system ensured one thing: the flow of money would never stop. Workers would keep investing, even when markets crashed. Governments would bail out banks to protect savings. The entire economy became anchored to the belief that the future could be bought, packaged, and sold. But beneath the graphs and growth charts, a question lingered. What happens when the future everyone invested in stops existing? By the early 2000s, the cracks in the retirement system were no longer hidden. The promise that markets could endlessly provide for everyone's old age was meeting reality, and reality was ruthless. The dot-com crash of 2000 erased billions in retirement savings overnight. 8 years later, the 2008 financial crisis did it again, wiping out the dreams of an entire generation just as they neared retirement. It wasn't just a market correction, it was a revelation. The system built to protect the future could destroy it just as easily. For millions, retirement savings became a cruel mirage. Decades of careful investing were undone in months. The illusion of control, that if you just followed the rules, your 401k would grow, shattered. What replaced it was fear. People who were supposed to be retiring started applying for new jobs. Parents moved back in with their children. The future, once financialized, had turned toxic. Governments responded with the same solution that created the problem: more money. Central banks slashed interest rates to zero, printed trillions, and inflated asset prices to restore confidence. Stocks soared again, but not because economies recovered, because there was no other place to put money. Retirement accounts began to heal on paper, but the real economy, wages, savings, and living costs, never caught up. The illusion was saved, not the people. And then came inflation. After decades of cheap credit and endless debt expansion, the cost of living began to outpace returns. The value of savings, those decades of deferred consumption, eroded silently. Every pension check bought less. Every dollar saved in safe bonds lost power. The retiree, who once trusted the system to deliver stability, became collateral damage in the war to keep the financial system afloat. At the same time, demographics turned against the system. Populations in developed countries began aging rapidly. There were fewer workers to fund the retirees, fewer taxpayers to support Social Security, and more people living longer than the system was ever designed for. What was once sustainable became impossible. The math simply broke. In Japan, retirees began selling off assets to survive. In Europe, governments raised the retirement age again and again, pretending it was reform, not desperation. In America, the average 65-year-old had less than $100,000 in savings, barely enough for a few years of living expenses. The dream of retiring comfortably had collapsed under the weight of its own expectations. And yet the narrative persisted. Financial media kept promising new strategies, new funds, new ways to catch up. But the truth was harder to accept. Retirement had never been a guarantee. It was a collective bet that the future would always grow. Now, that future was running out of room. In the 21st century, a quiet revolution began, not of youth, but of age. Across the developed world, retirees started returning to the workforce, not out of choice, but out of necessity. Supermarkets filled with elderly cashiers. Delivery drivers in their 70s became a normal sight. Headlines celebrated their work ethic, but beneath the praise was tragedy. People who had done everything right, who had played by the system's rules, could no longer afford to stop working. This was the new slavery of the elderly, a generation trapped by promises that no longer existed. Pensions had shrunk, savings had evaporated, and healthcare costs had exploded. For many, retirement now meant trading stocks from a laptop at 2 a.m., renting out spare rooms, or driving ride shares to pay the bills. The dream of freedom had become a fight for survival. Governments disguised this reality with statistics. They called it extended participation in the labor force, a positive trend, they said, proof that older people were staying active. But behind those numbers were millions of broken plans and abandoned dreams. People weren't working because they wanted to. They were working because inflation had erased their future. Corporations, meanwhile, found a new form of profit. As traditional pensions disappeared, financial firms turned retirees into customers. Every stage of aging became a market. Reverse mortgages, annuities, senior health plans, longevity insurance. Retirement wasn't about stepping out of the system. It was about staying inside it until death. The same institutions that once promised security now profited from the insecurity they created. Even the concept of ownership changed. Housing, once the ultimate retirement asset, became another trap. As home values rose, many retirees found themselves wealthy on paper, but unable to access their equity without selling the homes they hoped to die in. The market had turned shelter into speculation. The supposed reward for a lifetime of work was dependence on loans, subsidies, and the mercy of the next generation's productivity. In the developing world, the crisis was even starker. Without strong pension systems, the elderly were left behind entirely. Family support networks strained under economic pressure, while younger workers migrated to cities, leaving parents and grandparents behind. Aging, once seen as a stage of wisdom, had become an economic liability. This is the part of the story no government wants to tell. Retirement didn't fail because people were irresponsible. It failed because it was never meant to last. It was built for a time when populations were young, growth was endless, and trust in institutions was absolute. None of those things exist anymore. The generation that believed in the promise of retirement now lives its opposite, a permanent state of working to survive. And in the shadow of that realization, one question remains. If retirement was never real, what replaces it? The collapse of the retirement dream isn't just a financial event, it's a cultural reckoning. For over a century, society was built on the belief that life had three neat stages: education, work, and rest. You learn, you labor, and then you retire. It gave people direction, governments structure, and corporations a cycle of consumption to depend on. But as that structure unravels, the truth emerges. The idea of permanent rest after a lifetime of productivity was never natural. It was a narrative that served the system more than the individual. In today's economy, that illusion no longer fits. Technology replaces labor faster than ever, while debt replaces savings as the fuel of growth. The money you set aside no longer stores value, it erodes. The longer you live, the poorer you become. And so, the modern human is left chasing a goal that keeps retreating, a finish line that was never meant to be crossed. Retirement has become less a destination and more a marketing campaign for financial products that depend on your belief in the future. But within this collapse lies a strange form of liberation, the opportunity to see life not as a linear race toward an ending, but as a continuum of value. People are beginning to reject the traditional path. Many no longer dream of quitting work, but of redefining it. Freelancers, creators, small entrepreneurs, all are carving new versions of purpose that don't end at 65. In a world where money and time have lost their old meanings, meaning itself is becoming the new wealth. Still, that doesn't erase the damage. Generations were told that discipline, saving, and patience would guarantee security, and now they face the betrayal of that faith. The collapse of retirement exposes something deeper, the fragility of systems built on perpetual growth. When an economy requires infinite expansion to sustain a finite population, it's not the market that breaks, it's the people. Perhaps the end of retirement is not a tragedy, but a warning, a reminder that human life cannot be outsourced to institutions or priced by actuarial tables. That true freedom doesn't come from escaping work, but from reclaiming ownership of one's time before the system takes it. The story of retirement began as propaganda, evolved into policy, and ended as illusion. Now the world faces its consequence, a generation that can neither stop working nor afford to live. The promise has expired. What remains is a chance to rebuild a world that values contribution over consumption, community over compounding, and dignity over dividends. Because in the end, the greatest financial trap ever made wasn't retirement itself, it was believing that money could ever buy freedom from reality.